We're proud to have this episode sponsored by ShakePay, the easiest way for Canadians to buy and earn Bitcoin. I love using ShakePay because it's fast, it's easy, the app is great, and it doesn't hurt that they give away free sats, which is free Bitcoin, every day just for shaking your phone. They also have the ShakePay prepaid Visa card issued by People's Trust that earns you up to 2% cash back in Bitcoin. Not points you have to redeem, just Bitcoin added to your account automatically. Like I said, ShakePay really is the easiest way for Canadians to buy and earn Bitcoin. So join the over 1 million Canadians already on ShakePay. Sign up is fast and free. It's so easy, a boomer can do it. Plus, sign up for ShakePay with the promo code Loonie Hour, and you'll receive $10 after you buy your first $100 worth of Bitcoin. That's promo code Loonie Hour. Thank you, ShakePay. Now back to the show. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 65. As always, joined by the three amigos. We got Keith Dicker of IceCap Asset Management and Rich Diaz of Acorn Macro Consulting. Welcome back to the show, gentlemen. Rich, any new dates this week?
Sadly, nothing to report. well, maybe next week. I'll let you guys know. I've gotten some positive feedback of that. I'm mortified by all of this attention. It's just something I'm not used to. But yeah, no, all good on that front. It was a good New Year's. Kept it really, really quiet for once. I guess that means I'm getting old or slow. Or what do you do, Keith, with Mrs. Icecap? Do you guys go to bed at 10 o'clock?
Well, first of all, I'm interested in the feedback you receive on your dating.
No.
Is it a strategy or skill? What would you?
I've been given advice.
Like with me, it's innate. Like I just have it, like I'm like the Fonz. But I know you struggle with being, rich.
I do struggle with being rich. I got some advice. I've gotten some encouragement.
I thought you had a date tonight. Did she cancel?
No comment on that. I can neither confirm or deny.
She's canceling to watch the Canada World Juniors as well.
Yeah, that was amazing. Connor Bedard, did you watch it, Steve?
Yeah, well, we obviously canceled rescheduled our live Q&A, which was supposed to be yesterday. We're recording this on Thursday, of course. So the live webinar has been bumped to next Wednesday, January the 11th, 4:30 Pacific time, 7:30 Eastern. The registration link is the exact same one that we posted last week. But again, if you're listening to this episode, we will include the link in the description below, as well as on YouTube here in the description. So like I said, go register for that. It's completely free. We'll have a blast, have a couple drinks, answer some questions, and just have some fun building the Loonie Hour community here.
That'll be fun next week. So we'll have a good bit of fun with it. And we had a great New Year's here. Mrs. Icecap and myself, we actually Mrs. Icecap was working all weekend. So she has some pretty long shifts to pull through. So we weren't that active, but we had a big game of Catan with my daughter and her friends. Do you guys know that game?
Yeah,
no,
Settlers of Catan. If you know, you know.
I've heard of it.
Yeah, I'm pretty good at it.
There's no chance you're staying up till midnight, Boomer.
Yeah, I think it was like 11:20, I think, and it was done. But anyways, what do we got this week? What's happening? Week number one, right?
Week number one. We know just setting ourselves up for a big year here, and obviously that's why we figured we'd do the Q&A, because we know people probably have a lot of questions. I'm getting a lot of questions, anyways, on the housing front. Is this people sitting around with some cash and saying, "Is this? I've got some cash. I want to deploy it. I want to buy. I want to do something this year. When's the time to buy? When's prices going to bottom?" When are central banks going to stop hiking rates? So there's a lot of questions, I think, that are going to be answered here in 2023. It's kind of been building to this crescendo, but just kind of round things out just on the housing front. We're getting sort of our year-end December figures coming in. So, looking at the Toronto housing market, for example, so sales fell 48% year over year in the month of December. Benchmark, the MLS home price benchmark price.
Sorry, Steve. Was that
Go ahead.
like the quantity of sales? You say it's down 48%
Yes,
for the price.
The number of transactions, basically. So the number of transactions fell 48% year over year in December. So obviously base effects, last December was piping hot. But, nonetheless, a very, very slow December in the GTA. Benchmark prices down 8.9% from last year. I think that's one of the largest decreases. So it was the biggest drop for the calendar year since the benchmark was first created in 2005.
Can I ask you a question? Sorry. Or just on the volumes thing? So what was the peak? What month was like the peak volume?
Typically, I think it would have been, I want to say March
of 2021, right?
2022.
Okay. So what is the sales volume from, like, we know that prices are down, whatever, 15%. Some cases it's more, some cases it's less. But what's volume from that peak? Like, if like 70%?
Oh gosh, yeah, I don't know. I don't have the figures in front of me, but it'll be a massive number. I mean, I am curious to see, like, we talk about base effects quite a bit. The base effects, I think, are going to look really ugly in like Jan, Feb, March this year.
That was my question. Yeah,
they're going to be horrific because we basically had that blow off top, which ultimately ended in February. So trying to compare like benchmark prices on a year over year base effect from that, sales volumes, et cetera, it's going to be ugly. But similar story in Vancouver, not quite as bad. The GTA is definitely getting hit much harder. So Greater Vancouver, so home sales on a year over year base effect in December down 51%. 51% decline in home sales. The home price index finished down 3.3% on the year. So not as bad. But if you look at the home price index, over the last 6 months, it's down about 9%. So that's, if people go in, we've talked about this, we don't need to explain it again, beat a dead horse about rate of change terms. But so yeah, heading into the year with some really soft data, I think the base effects in Jan, Feb, March are going to look pretty ugly. Are we going to get another Bank of Canada rate hike? January 25th? Maybe the last one. Maybe they're done.
Sure, why not?
we might have to bet a lemon loaf on that one when it comes
we're definitely
up.
going to bet a lemon loaf.
Is that a new thing for 23? Lemon loaf?
We're moving up in the world.
Maybe we need to move on from the Twinkie and we'll come up with something.
They've refused to sponsor us thus far. So
yeah, maybe we should move on. I have another question on the real estate thing. Are you seeing differences in condos versus single family homes, or is it just everything's?
Yeah, no, it's together? A good question. So basically what's happening is the detached housing market always tends to lead the rest of the market. So the detached market will go up first, it will then correct first, and then like everything else kind of tends to follow suit. So we've seen the largest correction in like suburban single family houses, and like townhouses are not far behind. And then condos are a little bit further behind that. So I think there's probably I actually think there's probably going to be more downside in the condo market this year.
That was my next question. You beat me to it.
Yeah, I think people might shoot me for this. I think the detached, I think there's probably some more room to go for sure on pricing, but I think it's getting pretty close to a bottom. Condo market, I'm not convinced. Like, you've got a lot of these pre-sale buyers.
Whoa. Did you just call the bottom? It's
no
anything?
I said it's getting close. I think okay, so some of these markets in the suburbs, they're detached markets, some of them are down 20, 25. In some cases, extreme cases, are down 30%. So do they have another 5-10% to go? I would probably say there's a decent probability of that. I would say high probability. I don't know.
We're gonna hold you to this now.
Yeah, exactly. Someone's gonna
Go.
clip this and rewind it back. But I don't mean, like, you're getting a 30% discount. Not bad.
Right now, though, with the market coming off, and this is just an opinion. I don't know if we can measure it yet, but in my view, it's primarily driven by the rate hikes.
Correct.
Correct?
100%. 100%.
And as well as the banks becoming less enthusiastic about lending, so spreads have increased as well. But we've yet to get job losses, right? So
Yeah.
so I'm not calling a bottom yet, and when I do, I know I'll be right. But come on, you're supposed to chuckle when I say
No.
that, Rich. Rich is like my soundtrack, used to watch
Oh,
like Three's Company and Happy Days. You get this, you guys don't know those shows, right?
Laugh
But-
track.
Yeah. But I suspect if we do get a recession, it actually hits, then I think that will drive things down further. If we don't, though, if it is, this is it, then maybe we are getting closer, to that bottoming.
I mean,
process.
I think the important thing is like these calls are always changing, right? Like as the data changes, like you need to change your mind. Like I don't know if there's some sort of data that comes in, 8 weeks from now that will should alter your opinion, then I'll change my opinion. But I think as I'm looking at it today, looking at the data, the big story here is like there's no inventory. Inventory levels are half of what they were in 08, 09. I look at a lot of the markets, like, a detached house on the west side of Vancouver, like the people that own these $3 million houses have no debt on them for a lot of these houses. So like, I don't expect that market to be swamped with inventory and dropping 40%. But like, yes, there's a lot of these fringe suburban markets that are blue collar, people levered up to the gills during the pandemic off Tiff's words that rates would stay low forever. And so, yeah, they're going to pay the price. And I think they already are. And I think there's a lot of pain points that we're looking at, which is like the pre-sale market that was extremely speculative. There's going to be a lot of, I think, investors that won't be able to qualify for mortgages when these units come due for completion. So there's going to be some stress there. There's going to be some developers going bankrupt. I think that these rate hikes haven't quite bit yet in terms of increasing the number of foreclosures coming to market. I don't expect us to be flooded with foreclosures, but I think like for sure we're going to see more. Like,
that was my question. That was my question. The reason I was bugging you about the condo thing is because I keep reading articles about how there's an incredible wave of condos coming onto the market in Toronto specifically. And I was just wondering if you've heard of like developers or people just saying, forget it. We're just going to close up shop because there's no way we're going to make money or whatever it is. And I'm just curious about like, maybe Keith, this is one for you too, is like, do you think there's like a systemic issue that we might see? Like, if enough of these construction companies go bankrupt or they stop building, remember, real estate and lending and leasing is like the largest chunk of our gross value add in Canada. Well above energy and manufacturing and other services and stuff. So my point is like, can we see a systemic, can we see this like sort of cascade into other parts of the economy? I mean, is that even possible? I mean,
yeah, it's absolutely possible. And I think the probability of it happening is a lot higher than what everyone is expecting out there. It doesn't mean it has to happen, of course. Yeah. But it's not a non-zero event, and we keep going back to what we just introduced the concept just a few minutes ago, that we're getting this softness, if you want to call it that, in the housing world. We've yet to have a recession.
Yeah, it's true.
So if we do get it, and then you get all because the housing market is and banks by nature, they're levered. Structured, it's a levered business altogether. So you have a small amount of your equity and then you borrow on top of it, right? It just takes a small move in any of these things to push someone off sides, and then you get the cascading effect with that. And what I find really interesting about this, and I was chatting with someone yesterday about someone they're European based. Canadians have not experienced this before. Can you guys hear Willis?
Yeah.
Oh.
Just give me your thoughts on it, then I'll continue with this as well.
The only go for it.
Go ahead,
Sorry,
Rich. You go ahead.
No, I was just going to say, I mean, we are talking about Canada and eventually we'll move on to the rest of the world. What I think is fascinating is that Germany's seeing a correction, Sweden's seeing a correction,
New Zealand,
year-on-year house prices, New Zealand seeing a
Australia,
correction, Australia, and house prices year on year, much to my chagrin, in the UK are going to go negative year on year. I mean, it's we've talked about the great rate reset, which is one of my themes for 2023. We really haven't seen it. And I think Keith's point about how Canada really hasn't seen much of the pain yet either. I think it's really interesting. But anyway, Keith's back from.
You guys have me all worried now that people are going to take my detached market pricing bottom out of context here.
Yeah, so we're going to clip it.
I'm still incredibly concerned about where or what could happen. However, looking at strictly the data points in the housing market in isolation, I think people are more insulated.
It's too late, Steve. It's too late. You're going to be
markets.
clipped. You're going to be clipped now. Keith, go for it.
Well, like a slightly different observation, which sort of is in line with housing. So, Rich, so before I talk about, I had a conversation with a friend yesterday about, what could happen in Canada. But what I love is ties in with the whole housing market here. It's behind your right shoulder. You have some beautiful flowers. Where do they come from? Why do you have flowers in your house?
I like flowers and I bought myself flowers. The flowers are beautiful and cheap in this country. And so, every once in a while I bought lilies. It's to spruce up my life.
You're supposed to use that in your date props.
So
she comes back and she goes, "Oh, wow, where'd those flowers come from?"
Oh,
listen,
ladies, anyone,
listen,
if there is a lady listening, if there is a lady listening to the show here, this guy is quite the catch.
Oh, brother.
So we'll call this the flower episode in the end. But with the Canadian economy, and I think we've sort of danced around this before. The Canadians have never experienced a national crisis economically. Like, it hasn't happened, and we've never experienced one in the banking sector. And I don't mean to say this to be alarming. I'm not going to be like Steve and call the bottom of a market.
Oh my God. This is
However,
I'm never gonna hear the end of this one.
Yeah, I know. It is a good one though. It's quite. I try to deflect attention with Rich's flowers, but boy, oh boy. But serious though. If all this starts to develop the way that the path is there, you can clearly see which way this path is going. And again, it could be an external event, something outside of Canada that triggers it. But Canadians are not prepared for any kind of a crisis with our banks. And, and the Canadians say, well, it's never happened before, so means it will never happen. But that's not the case. That the risk is there and it is escalating. So if we do get a recession coming up, then it is going to put more pressure. And then to say Japan goes, pow in the middle of the night, or the Europeans. We got to talk about central banks in a little bit as well, by the way, because it is all tied together here. We are lined up here for we could have some pretty big movements here in the first in Q1 or Q2 of 23.
So a couple last little tidbits, as we talk about bottoms and whatnot, in certain segments, as we mentioned. But there's one stat that I noticed that came out here that I found, very, very interesting, which is like, this is when I say, hey, there's going to be, more stress building up in the markets. And I worry a lot about, some of these condo investors, these pre-sale guys, et cetera, but typically tend to be more speculative. They tend to be, floating rates because they want like the optionality to get in and out of these units. So in January 2022, which was pretty much right at the top of the market, the stat is 57% of borrowers in January 2022 went with a variable rate mortgage in Canada. So of course, your variable rate is up 400 basis points since January of 22. So there's a lot of borrowers that are finding ways, I think, to make their mortgage payments, but I think they're definitely struggling. And just hearing a lot of, against, we've talked about it before on the show, but a lot of anecdotal stories. So that's something I think will sort of shape up in the new year.
I just want to contrast that with the US, which is, I think, again, it's like we always, Canadians unfortunately can compare themselves to America, I think, way too much. I'm going to add to that unfortunate trope. But what's fascinating is in the US, for example, 90% of the mortgages are fixed rate. And this is not fixed rate, this Mickey Mouse 2 years fixed rate. This is 30 years fixed rate. And it's incredible because that basically all happened when mortgages were, below 4%, let's just say. And so it's just an incredible difference between sort of how exposed you are to those rate hikes. And again, I've talked about this before, why I think the US housing is going to be relatively okay. And also why I think, just like Canada, New Zealand, Australia, UK, a lot of these sort of economies in the developed world that are really, really rate sensitive are going to have a really hard time. That obviously has implications with the central bank interest rate policy, inflation, and which we'll talk about a little later. But it's amazing the contrast, really.
I think
that sort of brings us.
It
brings us back to the real question. Everyone is asking now: when will the central bank stop raising rates? When is it going to happen? And we heard the expression, they'll do it until they break something, and other people are saying, well, they'll keep doing it until inflation data starts to roll over, and that's already happening, of course. However, the Americans, the Federal Reserve, they've been crystal clear. They are looking at the employment market, and as long as employment remains somewhat strong or stable, wage growth is still positive, like, they're going to use that to continue raising rates. So here this morning, I think we have 2 economic data points out this week down in the US, and Rich will go through them in a second, but maybe Rich talk about the first one, which was we had the weekly claims out this morning as well. I think it was the ADP employment data that came out. And so both numbers, especially the ADP number, by the way, ADP stands for automatic data processing. If people are not familiar with that, so for many companies around the world, and in the US, especially in Canada, no one does their own payroll. You outsource it because it's an incredibly intensive service that has to be done. Instead of hiring 1 or 2 people to do it, you just outsource it. And these guys have the primary market share for it. And for example, RBC used to do that business a few years back, maybe 20 years ago, but they sold it to ADP, to give you an example of what it's like. But they have access to so much employment data all the time. So that's why they've created this metric, this data point. That's what it is, ADP. But yeah, again, the number this morning, like it was strong. And all of a sudden that gives the Federal Reserve more support to continue raising rates or not pausing. And markets are getting a bit mullered there this morning. But do you have any more data on
I've
that?
got a quick question now. Maybe this is for you or for Rich. Is there not a large divergence today, right now, between like the household survey and the ADP data, like the labor force statistics? I was listening to a podcast there in Grant Williams with I think it was Steph Pomboy. She dives into a lot of these numbers, and it was her opinion, anyways. And there's a lot of opinions out there that the divergence today between the household survey and what payrolls are reporting is, I think, the largest or widest spread since the GFC. So she was of the opinion that it's one of these data points is wrong. And she's of the opinion that the payrolls data tends to lag the household survey.
So just for everyone to understand, that the household survey means, I forget which group is doing this survey. Is it the government entity, or is it
the non-farm payrolls is the Bureau of Labor Statistics that comes out tomorrow?
But that's contacting corporates, isn't it? Or are they contacting?
No,
households?
so she was saying that they basically call, like, they're calling basically more small businesses.
Yeah,
which is
but they would
small
call up a
business
house,
makes
say,
up the
hey, is
majority
everyone
of.
working there this week who worked last week and stuff like that.
Yeah.
Whereas you are right, the ADP number, it's measured from the top down from corporations. And Ron, I know I just said, hey, this caused the market to move here this morning. Historically, there's not as much weight put on the ADP number. So, and again, not to make a joke about it, today is Thursday, which the ADP number came out on, and tomorrow is Friday. And for everyone in economic junkies out there, the first Friday of every month is an incredibly important month. You get to bet with all your friends on Bloomberg what the non-farm payroll number is going to be, or the employment number. And so when this comes out tomorrow, we'll have another big market movement tomorrow morning. But the market movement today is in anticipation of, again, the employment number being strong again tomorrow. I know that's a bit of a word salad, but it is what it is.
I don't actually know I don't know the answer to that. And maybe I know someone sent an email about that. I'm of the view that there's loads and loads of revisions. And I think that you should never take just one single data point. I think that the JOLTS number that came out, which is the job, I never remember the damn JOLTS acronym, but basically the amount of vacancies that you have is continues to be really strong. And I think so. I mean, that's like kind of a non-answer as I waffle pretty badly here, but I think that they do get revised. So for example, the ADP number that Keith was referring to was actually revised up. So last month was revised up significantly, almost by 80,000. So almost like 30% it was revised up. And so this is the thing with these numbers. I think it's about sort of central tendency. It's about not just looking at one or the divergence between one or the other. I think it's in general, the idea that the US labor market is soft, I think is categorically wrong. I think to say that it's softening is fair. Does that
I mean, I think there's
question.
What was Steph saying, Steve? I didn't listen to that.
Yeah, it was a fantastic podcast. I highly encourage people to go and subscribe to Grant Williams. He's the original founder there of Real Vision. But he's always has great guests on. But Steph Pomboy basically, she was of the opinion. She sort of disagreed with Grant, but she was of the opinion that she has in her models. This is what she does for a living, and then maybe she's looking at the data differently than other people were. She was of the opinion that U.S. CPI. I think she was saying that she has it in her models getting back down to 2% by June or July. So headline U.S. CPI year over year will get down to 2% in June or July. Basically, she had the gap between the labor force household survey and the sort of payrolls numbers coming out was the widest divergence since the GFC. And then she also mentioned things that we've already talked about before, which was the CPI inflation. So she was like, look at the shelter component of inflation. She goes, you remember back in the global financial crisis, the housing boom, the housing market ultimately peaked in 2006 and began to roll over. And she says 18 months later, shelter component of inflation finally peaked and began rolling over. And that was, I think she was saying about midway through 2008, shelter component started to roll over. And that was, a couple months later, you had Lehman Brothers go under, right? So she was like, this is just not a great leading indicator. And she was, basically saying that shelter today is what's responsible for the majority of the increase in inflation. So again, different perspective. I thought she made some very good points. I think there's an argument to be made that you can kind of look at the data and crunch the numbers in a whole variety of different ways and come to somewhat different conclusions each time. And I think this is the ongoing debate on Wall Street. And I think it is a reason to stay humble, right? I mean, markets are hard to predict.
Except the housing market bottom.
That one we know 100%.
I mean,
no humility with that one.
I mean, that reminds me of a quote. I'm sure it's been misappropriated to, Mark Twain, but there's lies, damn lies, and statistics, right? You can make them say whatever you want. Can I just ask you a question on what was her conclusion that that the labor market is weaker than we think, or stronger than we think.
She thinks it's weaker than what's being reported. She thinks that, everyone is basically struggling with the idea that inflation can come down from, where it is to 2%. People seem to think it's going to take, year, 2 years, 2.5, 3 years. It might never get down there again. And she's arguing that it can come down a lot faster. I think she also brought us some sort of stat of like, CPI inflation was running in the fives back in what, 07, 08. And she said it came back. She said it went down to negative, 2% or something in 09. But she's like, granted, we had the global financial crisis, but like it went from 5 to -2 in a matter of basically 12 months. So that was her conclusion. She thinks the Fed basically was looking in the rearview mirror and was going to over tighten.
I mean, she's not here to defend herself, but I would just suggest that there's lots of market-based inflation expectation instruments. So, I mean, there's like swaps and different futures instruments and the break-even rates and inflation protected bonds, which are known as TIPS. A lot of these are already pricing in what she's actually suggesting. I think it's more the modeling economic guys who I think will say it's going to take longer. I would also just remind everybody that it's not headline inflation or even CPI that the Fed targets, right? It's core PCE that they target. And so that's just something sort of to remind us by. But maybe we should move on to the ISM numbers and we can talk about that quickly. And then, or if you have something else.
No, I think, you go into the ISM because there was a good chart I think I sent in the group chat there, which we'll get into, but go ahead.
Well, yeah, the ISM just ticked lower. And so remember, it's a diffusion index. There you go. That's for you, Keith. And we've discussed diffusion index before. Something I should
work again. I forget.
No, you're not tricking me this time. But anyway, the key things I think for me was, number one, there's 3 points that I'll just go quickly. Number one, it's below 50. So you've got the sort of contraction expansion line. This is the second month in a row that it's contracting, or the manufacturing sector is contracting, I should say. Remember, the services sector in most developed economies is the larger of the two. There's services and manufacturing. And then you add them up together and you get sort of your whole economy. In the US, it's 20 to 25%. Again, some people can argue whatever. It's more or less, 3/4, 1/4. So the manufacturing, which is what we got today, went to 48.4. That's below the 50 line. So it's contracting. That's 2 months now after something like 29 or 30 months or whatever expansion. It's also contracting faster, which is interesting. The things that the other points that I want to talk about was employment. So we were just talking about employment. That went below 50 for the first time in a while. All this stuff about supply chains, I think, is really important to note. Of all sort of come in, whether it's prices, backlogs, consumer inventories. That's the other thing that I thought was really interesting. And then as I tell everybody that you can look this up online, it's freely available. The website's really, really quite slick, actually. And I like to look at the comments section. So just like our YouTube comment section that will remind Steve of his call about the bottom in the housing market, on the ISM services report, they go and ask a bunch of people from different industries. So chemicals, manufacturing, plastics, transportation, and whatever. And the thing that just continues to surprise me is even though people are worried about employment, so let's say their hiring plans are starting to deteriorate, they're still bitching about labor market shortages, which I find fascinating. The same is true, by the way, in Canada. So we've talked about the CFIB, which is the Canadian Federation of Independent Businesses. And even though you can see the PMIs in Canada are falling and the business sentiment is falling in Canada, and even consumer confidence is falling, the stubbornly high labor quality component is just not going away, which is, I think, just a really sort of fascinating quirk of this cycle, which is sort of unlike what we've seen before.
Lagging indicator.
It is a lagging indicator. We've talked about that.
I think though that comes down to like, I thought last year was pretty clear, or not clear or obvious. The probability of this path that we expected last year, I thought it was a lot higher than what I'll suggest coming up this year. But in 21, we were on this like euphoria train. Everything was awesome, and just using a lot of different metrics for rated. You can tell it couldn't get any better. Like that was it. All the money has already gone in. There's no one else left to buy, and it should roll over. Now coming into this year, it carries on with what Rich just described to us. We're starting to see some sluggish growth coming up. So you listen to other people, what the reviews are and stuff like that. So we're either going to get, this recessionary death trap coming up. It's just the hand's going to come up and grab and bring you down with it. Or, we get this, the Chinese recovery. It's real. It's going to be really strong. That's going to help the world. The Americans actually don't have a recession. Maybe it's just a slowdown. And you get that. So it's really is this binary outcome. And just say let's go through each scenario. Okay. So let's say that the Chinese recovery, it's really strong. Like it's awesome. So that means growth will remain strong around the world. They're going to start pumping stuff out again, which is deflationary, right? Because China, they export deflation because they make cheap stuff.
I'm not sure about that, but keep going.
Yeah. And let's say the Fed in the US, they avoid a recession, it's kind of sluggish growth. But in that environment, that allows this inflation should remain somewhat elevated. I do agree with Steph. I think inflation has potential to come down really hard with the numbers that they calculate. But we could be in this environment where the central banks, especially the Fed, they continue to hike rates because they're looking at employment growth, wages, and all that stuff. And it seems like that's what the Canadians are looking at as well. So let's jump to the other side. Let's just say it is a hard landing. It's not a little slowdown or a little recession. It's like a big thump or thud. That's going to be negative for earnings, especially. So for people who live in that fantasy land of PE ratios and stuff, the P, which stands for price, that's already come down in 22. But the E has stayed elevated because it hasn't been adjusted yet. And we talked about this last week. But in a hard landing, all of a sudden that E is going to come down. And all of a sudden, that's how you square your valuation. You go, oh, wow, it wasn't cheap after all. But then we could, we were going to get this real awkward moment where equities could come off. So there seems to be no middle ground. Like I'm seeing it's either one or the other. And we'll get more, as I think Steve, you said earlier, we're going to get more data points coming in all the time, and we'll be better able to square this up. But
please don't make any Canadian real estate investments without contacting me first. The bottom, I'm really upset that you guys are.
I think we forgot.
Now that I'm on it, I want to clarify something. There's a certain product that is down. Now, the home price index is going to, I can almost guarantee you the home price index will continue to decline probably for the next 12 months.
Okay, we will not hold this. We will not hold it to you.
You can take that to the books. The home price index, lagging indicator, smoothed out from a rate of change perspective, will continue to decline probably for the next minimum 8 months. Minimum.
We're just teasing.
I know you are, but I just don't want people to take that out of context and go out there and spend a $2 million house and it drops 15%, and then I'm getting a DM that comes through.
But one thing, so back to, sorry, if I may, just back to what Keith said. I think that Keith's highlighted it's like a really important. We're in this period, and I I've been told that I should disagree with Keith more, and right now we sort of agree. But make no mistake, when I do find some differences in our opinion, I'll be sure to say it. But I think what's amazing right now is we've finished sort of a 15-month, 16, 18-month period where stocks and bonds have sort of moved together. You had the rotation into energy, which is finally capitulated, and now we're in this there's always themes, there's always narratives in markets that you sort of try to pay attention when you're a strategist. I imagine investors sort of do the same thing, and they sort of help you sort of explain and then help you allocate your asset allocation. And then below that, you've got your portfolio construction stuff. And I think that that's what's so fascinating right now is that we're sort of in this era where the world and the market is trying to sort of figure out what is the next stage. Do you have the S&P 500 sort of blow through the 200-week moving average as the world worries about, continued recession? Do you have the US consumer, which I believe is actually really, really strong, despite some misgivings on the employment side, sort of save the day, as the US consumer seems to always save the day? Do you have the China situation? So I think China opening is actually inflationary. And you can see it in what's going on in the industrials metals market. So tin, zinc, copper, Dr. Copper, one of the most important sort of indicators for economic growth, continues to rise. And I think, for the first time in maybe a year and a half, I'm actually not quite sure about which direction we're sort of in, and which is why I continue to be quite sort of defensive. But I think over the next couple of months, I think all these sort of pieces will sort of fall into place. And I think it'll be very, very clear what the next leg is, or the next narrative is.
Okay. Keith, you go ahead, because I want to chime in. I have a question for you, actually.
For me?
For you.
Okay. Well,
Personal
Rich,
question.
I think it's excellent that you get this out of your system before your date tonight, because that should be helpful.
Oh, you guys are so mean.
I think
let's make fun of Steve. I like that better.
Keith, when are we buying?
I from my perspective, the best defense is a big offense. So I'll just go at you guys. But so one thing that we're very curious about here is usually with central bank policy and then government spending policy, which is spend. Usually it makes sense. It's intuitive. You can say, okay, yeah, I get it. I don't like it, but I know what you're doing. But if you look at specifically what the Europeans are doing, the ECB, so right now their overnight rate is at 2.5%, and they've told us that their inflation expectation for this year is 4%. So by default, they're going to have to hike rates by almost 2% this year, 1.5%, 2%, just to get it up. And so their last meeting, it was pretty hawkish or aggressive, what you want to see there. But yet they're going to be doing this at the exact same time when their data is rolling over, they're going into a recession. And their objective with raising rates is to pull inflation down. And I'm not convinced, that's going to help with their price increases, that's happening over there. But when I mentioned earlier that, there could be an economic or financial market shock around the world, again, Europe continues to be a very strong candidate to be that market, because they're raising rates aggressively. I don't mean little piecemeal ones. They said, hey, we're going to be aggressive here. And then you have a lot of other, factors swirling around Europe right now in terms of geopolitical risk and whatnot. But for Canadians, we're trying to figure out what will the Bank of Canada do? Would our economy get hit? I strongly encourage everyone to continue to look outside of Canada. What could be the trigger point? So again, raising rates into a recession, that's not what they teach you at university or wherever else people go these days. School. Central bank, which is Goldman Sachs, right? Goldman 101. Yeah. What do you have, Steve? What is your question?
No, I mean, just to kind of tie into that, because I tend to agree with what you guys are saying, right? I mean, I think I'm positioned personally, in my own sort of portfolio, I suppose, is on the bearish side, heavier in cash and waiting for opportunities. But I'm always kind of looking for what can this where can I be wrong, or where can this thesis go wrong? Because I look at a lot of things that we've talked about, pardon me, on this podcast. So a lot of the narratives, let's say 6 months ago, right, was one of them was all the Europeans are going to be freezing in the dark. And then you look at, you fast forward today and you look at, natural gas prices, and you're it just figured itself out somehow. I don't know how it did, and so there's a lot of things that people are so dead sure on, and then the opposite happens. And so I'm just looking and saying, okay, well, what is the pushback on this? So my question for you guys is everyone, myself included, seems to be positioned for sort of the negative event. This is the most forecasted recession, I think, in recent history, right? Like everyone's like, yeah, 2023 is going to be a crappy year. We're going to have this recession. Central banks are basically telling you they need to induce one. And everyone's basically positioned or seemingly positioned for it. Do you get, like, is it from a sentiment perspective, is it like the slightest bit of like good news or less bad news that the market suddenly just, rips to the upside? I'm just curious. I'm just trying to play devil's advocate and saying, like, where could we potentially get this call wrong, or where could investors be surprised by?
I'll go first. So the surprise could be is that we don't get a deep recession. We sort of muddle along through the year, and mind you, we continue to expect that if there is a recession coming up, the Americans are the last to see it. So they're not the leading market for recession. It will come from elsewhere, like specifically emerging markets. I think that market is always vulnerable. But just say we get, growth isn't great, it's not bad, and wage growth comes under control. Like companies just stop hiring as quickly as they did, and you sort of, squeeze our way through it. The financial markets will still have to react to that as well, because it's going to say, oh, wow, we weren't waiting that. But I just think that most markets, so whether it's credit spreads or earnings side on the equity side, and again, you go back to central bank policy, like at some point they would have to say, yeah, we're now comfortable with stopping. And whereas the Fed is always they try to be as transparent as possible with what they're going to do. The Bank of Canada, my God, like you have no idea what they're going to do. So right now for the Bank of Canada, they're in the market's expecting a 25 basis points hike here in late January, and then that's it. But they could come up with 50. Right? You don't know what they're going to do. So, I mean, the long about answer, Steve, is yeah, like it could. Remember, the economy could move in a different direction than financial markets. And financial markets, in our view, like they're stretched in several different ways now. So if we do get these whipsaws taking place, and you're properly positioned for it, or to do something afterwards, then I think people can actually make a lot of money this year. What do you think, Rich?
So I think so. I'm going to answer from just a completely different angle, just to sort of spice things up a little bit. I think, Steve, your point about the sentiment, I think is really quite spot on. I think it. If you look at things like net speculative positioning, which is sort of the options that investors might take out to hedge this or that, it's actually quite low. It's at sort of almost at all-time lows. If you look at investor sentiment, so the American Association of Independent Investors, got that acronym right for once. You look at bullish versus bearish. You compare those two, you're at all-time lows. If you look at cash allocations are actually quite high relative to history. So people are, you can see in the data, there's loads of data to support the view that people are actually quite bearish. And in a way, you're right. It's tough to get a material drawdown of sell-off when everyone is already sort of expecting a negative outcome. It's about often you get negative outcomes or positive outcomes when you have a difference between expectations and reality. And if everyone is already quite bearish and then you get bad news, then you often get a muted response. I guess the problem, so your point is, I think, extremely well made. And it's just something I think maybe not everyone sort of thinks about. The other thing that I would just add to that is, I just don't think we've seen enough pain, just generally. We've discussed this in the past. Like, credit spreads are high, but they're nowhere near what we saw in 2018 or 2016 or 2008 or 2020, right? Credit spreads are sort of an indicator of how much stress there is in the credit market. So the US corporate bond market, they're nowhere near those levels. I actually would argue that the market's actually become quite complacent over the last month. So Italy is always one of Keith's bugbears, and although we joke, he's right. The economy's in a lot of problems, and yet the spread over the German Bund has come in significantly. Credit default swaps, another sort of measure of market stress, they've all come in. And I would argue although there's a little bit of pain in the housing market, I would submit to you that should be way more. And so you've got this that's why I'm sort of stuck in between, right? Because I don't think we've had anywhere near enough pain on the equity market. Yes, sure, the equity market is down, 20% or whatever it is from the highs, or probably less now. But in some recessions you get down 38% or 40%. You know what I mean? And so that, I think that's this juxtaposition that you have to sort of play off, and why I think right now is actually a fascinating and really tricky time. Does that sort of answer the question?
Yeah, no. Like I said, I agree with what you guys are saying. It's more just, I'm always just trying to keep an open mind, basically, and that's what we talked about earlier in the show, which is like just continuing to watch the data points, and if the data comes in and says something else, 6 weeks from now, I think you should naturally start to form a slightly different opinion.
Yeah. Well, just like one more thing, like if someone asked me like, Rich, when would you turn bullish? And the irony is like, if the market fell 20% from here, I'd be like, okay, I'll be, given how negative sentiment is already, and the positioning, and the allocation that we've seen, and et cetera. If you got another lurch down, I would be like, okay, that would be one of the things that I would need to change my view on the market, if that makes sense.
Makes sense. I think because one of the things I get asked on the housing front is always like, when is a good time to buy? Oh, it's like I get this question 3-4 times a week. It's a lot of times it's from DMs from like random, people that, need, and it's like, well, I don't even know your situation. Like, well, what is your, like, when do you want to buy? I don't know. What is your situation? What are your cash levels? How long you plan to hold the property for? I mean, all I can say is like, from that's why I asked you guys about like sentiment and positioning, is on the real estate side. I noticed like everyone wants to buy the bottom, obviously. But I think everyone's like looking for like the home price index to like officially tick the bottom. And then they're like, okay, now I'm going to buy.
People do that in public markets too, just for the record.
Yeah, exactly. And so the thing I like to say is that the home price index lags very much so. And I find, at least in real estate, because the markets are not perfect, right? You're dealing with like emotional homeowners that are selling their properties. You're not dealing with, an open market where you click a button on your, your trading account and you buy a stock. So what I find on the real estate side is you're typically able to negotiate the best deals, despite what the home price index is telling you. You're typically able to negotiate the best deals when sentiment is the worst. And so that's why I was asking you guys of like, okay, sentiment, positioning, because what I find today, not a lot of sellers. There's definitely a few sellers that were like, when rates, some of the best deals I've seen negotiated so far was actually post the Bank of Canada's 100 basis point rate hike, like the week or two after that, because everyone was like panicking, going, oh my God, we knew rates were going up. This guy just dropped 100 basis points, and people just started freaking out, going like, what's next? And there's no certainty. And so my question is always like, okay, if we get clarification from the Bank of Canada on January, 25th, and he comes out and says no rate hike, and we think more or less we're probably done, we're going to watch the data to see if we need to raise further. Does that just, at least from a sentiment perspective, start to say, okay, well, rates are really high. That's going to be painful because they're going to be stuck here for some time, but at least we have some clarity that this is probably looks like the end of the rate hiking cycle. Does that start to change the sentiment a little bit? Not, you know what I mean? Not necessarily have to create a bottom, but it becomes maybe a little bit more challenging to really like grind a seller on the price. That's where I'm kind of coming from.
Rich was there talking away everyone, by the way, into his muted mic, and he was laughing. He said something incredibly funny, apparently. And
I just said it was a good question. That was it.
Yeah, it was. It's sort of like this, to sort of square all this up here. Like Rich made a comment there a few minutes ago that, you would feel better if markets came down a lot and then you'd buy. And, a lot of people, they embrace that opportunity. There's just to let everyone know, there's a different perspective. If markets come down so much and they, break different levels, and, then that's actually a bearish indicator, and that's when you say, oh, wow, this is even getting worse. So the simplest one right now, if you look at say the 1 year chart on the S&P 500, it's probably 3-4 times last year, we had lower highs and lower lows, and we're now into that next leg down here as well. So I think we can come down from here, maybe another 6, 8, 9%. And we're breaking the low that we just touched there a few months ago. And then the opposite is also true. So for us, for example, if the market started going higher and we exceed the high that we had a few months ago, then that's positive, that's good. And I think it goes back to, like, I like to joke about how valuations don't matter sometimes. And, sometimes they do matter, of course. Sentiment doesn't matter at other times. Other times it is incredibly important. That's why markets they're so fluid. But at the end of the day, when you have capital like gushing into or out of a market, doesn't matter if it's housing markets or credit markets or equities, you name it, oil markets, for example, the same thing. That's what's going to drive the price at the end of the day. So everything is linked together. It's not as simple as what we've been led to believe over the years.
I think that's, I always enjoy doing the show, just because I think I'm always learning from you guys, right? I mean, I'm always curious, Keith, how you're sort of positioning and obviously running portfolios. You've had a, great 2022, and I'm sure you'll have another good 23, but it's just interesting to get different perspectives. Because, markets can be, I know, it seem to be very humbling at times, right? When everyone's sort of convinced of one outcome, it can do the opposite, right? So, Keith?
I think that's a good way to end it. I don't know what else to add to that. Except, Gretch, good luck tonight.
Oh, man.
Good luck
It's a full moon. So we'll see.
Ooh.
I think that's and a good luck to Canada. And we're recording this on Thursday. So the gold medal, the World Junior Championship in Halifax. Keith, I'm disappointed that you're not at the game with someone with all the big bucks there. I thought you'd be in the box seats, but good luck to Canada playing for gold against Czech Republic. It should be a great match. Again, just to remind everybody that our live Q&A will be next Wednesday, January the 11th. I'm sure as we've kind of opened up this conversation today to sort of look at the bullish, the bearish arguments, how to position, how to think about markets. I'm sure people have a lot of questions. I've always got a lot of questions. So it's fun just to engage with our audience and get different perspectives and hear their questions. So we're looking forward to answering those. Once again, you can go and register for that. It'll be a link in the descriptions wherever you're watching or listening to this podcast. So as always, we appreciate your support. We'll see you next week.